again. This is Robert Schein, Managing Director, Partner at Blanke, Schein Wealth Management. Thank you for joining us on this Tuesday, February 15th of 2022. A lot happening in the news cycle. Markets are moving. We're paying attention to it. We're going to report on it, so you should be too. Thanks for watching. So right out of the gate, S&P futures gapped up higher on talks and reports that Russia is pulling back some of their troops. They're done with their military exercises, and apparently at this moment in time, it appears that tensions are easing. Again, that's for right now. Again, if you go back even a week ago, this is the most predicted, which is kind of interesting to see, sort of military engagement and military sort of use of force, at least just in the headlines, but nothing actually to play out. And that's one of the reasons why you always want to stay balanced, and as we do for our clients, because you can never lean too far one direction or too far to the other, because it's ever changing. Obviously, the volatility came in, and not so much from the geopolitical concerns that we saw last Friday. The temperatures heated up over the weekend from Russia and Ukraine conversations, and now they seem to be tempering. But even before Friday, we had also the market sell off by 1% in the S&P, immediately by the St. Louis Fed President Bullard. He came out and said he thinks that markets, or that interest rates need to, by the Fed funds rate, the Federal Reserve needs to raise in a supersized way, is his quote, sooner than later, meaning in March, 50 basis points for the Fed funds rate to rise, and then at least get at least 1% done between now and 4th of July. It's interesting because I think the Fed just tipped their hand. Bullard has always been the hawkish, not the dovish. Hawkish is more restrictive, more sort of the adult in the room, and calling it like he sees it. Now, what he also said is he has to now, he has his thesis, his base case as to why, but he also has to talk to all the constituents in the room and gather support and sort of for his sort of way of thinking. Now, if the market already knows what the worst case of the Federal Reserve, meaning the most hawkish, who just came out last week and ultimately sort of tipped his hand and said, this is where I think we should be. They know the worst case scenario. Markets reacted as a result, but it's going to start digesting that information and say, wait a minute, if we know what the worst case, the yield to worst is going to be, I don't think we're going to get that sort of the most restrictive. We're going to get somewhere sort of in between. And the Federal Reserve has always done this. In fact, we have another conflicting view, even the next 24-hour cycle, from another Fed chairman who's going to be, or Fed president, who was less hawkish, actually dovish. So again, as I said on Bloomberg, I was interviewed by Bloomberg this last weekend, actually during the Super Bowl, so money never sleeps, and we were ready for Bloomberg Radio. And in that report, I basically said even the Federal Reserve doesn't really know. What they're trying to do, what they've done historically, is use the headlines and use what's called the bully pulpit, so that they could get the market to do its heavy lifting for them, so they don't have to do as many interest rate rises. Why that's important? Because if Federal Reserve raises interest rates too quickly, they could actually cool off the economy and send us into a recession. That's very interesting, historically speaking, that they don't want to go down that path. So they're going to use the headlines, they're going to use the media, they're going to use all these sort of speeches that they give to sort of hopefully the market will do its work for them. Now, let's look at the board here to see if that's the case, because ultimately we're seeing a 10-year Treasury today over 2%, right? It's at 2.04% as I report this right now. And that's today's 10-year Treasury. We're watching this because the markets are really geared towards the 10-year Treasury in a lot of ways, both the equity markets, corporate earnings, fixed income markets, and that's usually the barometer of sort of longer, sort of shorter, longer intermediate dated interest rates. But the Fed funds target right now is still 25 basis points. Obviously, they want to raise it in March, and we're going to have to wait till next month to see what they do. Another 25 or 50. We don't know. I don't think they know, as I said. But let's look at the 10-year Treasury and the movement. And this is why the volatility in the market, we've seen this. So a week ago, we had 191 on the 10-year. A month ago, 177. And even a year ago, 1.20 on a 10-year Treasury. So you can see a significant movement, but the Federal Reserve hasn't raised interest rates, not even one time over this period of time. So now what you're clearly seeing out is the Federal Reserve is using the media, their speeches, their interviews to move the market and do the work for them. We're seeing this play out in the marketplace. Now, there's still room to run. I mean, there's still room to run for the 10-year Treasury. We could see it settle maybe between 1.9% and 2.2, maybe 2.25. We don't know. But what's next going to be moving is the short-term, ultra-short-term interest rates, and they're going to be rising. Now, can the S&P continue? Are the bulls going to win? Are the bears going to win out of this? Well, let's think about this. The geopolitical concerns seem at this moment in time to be subsiding. We have corporate earnings. We kind of know where they're lying. We could see interest rates sort of moderating right now between now and year end. I don't think the Fed's going to overdo it, because if they do, they could tilt us into recession. That's what the 2s and 10s are telling us, because the yield curve is now flattening is what they curve, what we call it. We do not want the yield curve to invert, meaning the short-term rates are higher than the long-term rates. That's a recessionary indicator that we would want to keep a close eye on, and so does the Federal Reserve. So as of right now, we're still in the sweet spot. So we believe that even though the S&P right now is at 4465, we believe that our base case at Blanke Schein Wealth Management is over 5,000 at year end at the S&P. Now the S&P is down 6%, and again that would put the S&P back over 11% between now and year end. So yeah, we do think there's room to run, but it's still going to be choppy. Choose your spots. We're going to be managing our clients' portfolios effectively by putting capital to work in high quality income dividend plays, sort of the boring stuff, but it works over time if you have a longer time horizon. And there's some great opportunities right now, because even in the S&P 500, the average constituent is down over 10% or 13% to be exact. So there's opportunities out there, and this is where we say, hey, let's take advantage of the market settling with higher interest rates. We have to see it. We're going to see it. The Federal Reserve selling off their balance sheet. They have up to $8 to $9 trillion in assets that they've essentially mopped up, and now they're going to have to reverse course and start selling that. And that's going to put forward even more pressure on the 10-year. So don't be surprised to see higher interest rates. We're prepared for it. We've had plenty of conversations about it, even here at Blanke Schein Wealth Management. But it still means that S&P 500 earnings can still come in very, very strong in the face of higher, not only inflationary pressures, but also interest rate pressures as well. So that's our update for today. I think we believe that the bulls will win this year. We will wait and see. It's going to be a touch and go. We could see a retest of the January lows even later this summer. But between now and year end, we're going to get clarity. We're going to get clarity with the midterms and a few other things that could help us. And hopefully the geopolitical tensions do subside, and we just continue to sort of get back to normal life as there's a reopening resurgence. We're seeing, if you watch sort of the Wall Street Journal and read some of the reports right now from the travel and leisure industry, a lot of these big companies that you've stayed at their hotels, these big chains, are on pace for better than 2019 right now in terms of revenue. And they're only selling half or 3/4 of their rooms, and they don't have corporate travel back online. And so you get corporate travel, big business back online. Even if you watch the commentators back on even CNBC, a little nuance that you're seeing is pay attention to where they're actually reporting from and being interviewed from. I saw 6 today, I just counted, that were actually in the office, and there's people behind them in the office. So that's a very positive sign. That means that the stay-at-home trade is not so much anymore. And those are, here's the deal. You could go back to the office. Only 1/3 of Americans are back in their office. We've been in our office, God bless, because we have a small office this whole time, working hard. But only 1/3 of corporate America is still back in the office, and that's kind of interesting to me. I think we have an obligation to be here, healthy and safe, but at the same time, I think more and more are going to come back to the office, because once you're in the office, you got a great culture, you got a lot of collaboration, and I think we're going to see a lot more movement. So there's a lot more to be done. So that's it. That's our update for today. But we're encouraged that we have some eases on some pressures from geopolitical. We sort of know the interest rate story playing out, and I think we're going to have that reopening trade resurgence continue. I mean, just look at the Super Bowl. You had quite a many people coming out, and they're long overdue for a lot of entertainment. And I think that's going to be the key. Travel and leisure is going to be the trade for 2022. All right, let's hope everyone stay healthy and safe. We'll see you again next time. Take care.